Knowing the rules and how to use them to your advantage is what pretty much all rich people do. And why should it be any different for you? So if you're watching this video, you're going to learn a lot on how to grow your net worth by using dividends, because it is important that you know the difference between qualified dividends and non-qualified dividends, aka ordinary dividends. We are going to be talking about pretty much everything that you would realistically need to know about dividends and how they are distinguished between qualified and ordinary. So let's just first talk about, just so we're all on the same page here, what an actual dividend is. So a dividend is a distribution to the shareholders of a company. So if you own a company, aka you own a stock within a company, that company can actually pass on like either profit or saved up reserves of cash onto the shareholders to basically keep them happy and show that they're making a good return on their investment. And so basically you are just getting paid for owning part of that company, from its profits or from its cash reserves, whatever it may be. And there are two main types of dividends that they can pay out to you. So that is the qualified dividends and that is the ordinary dividends. So what are qualified dividends? Well, they are dividends that actually fall under the capital gains tax rate, whereas ordinary dividends, aka unqualified dividends, those fall under what's known as ordinary income tax rates. So the primary difference between the two is the way that they are actually taxed, and that is the bottom line, is when they get to your pocket, how are they actually taxed? If they are qualified, then they are taxed at the capital gains tax rate, which is more advantageous, and we'll talk about that in just a minute. But if they are unqualified or ordinary dividends, then they are taxed at the ordinary income tax rate, which is less advantageous than the capital gains tax rate. And in order to actually prove this to you, let me go ahead and put up the capital gains tax rates real quick, just so you can see them. So this is actually the long-term capital gains tax rate, and this is what a qualified dividend would be taxed at. So you can see you're either going to pay 0%, 15%, or 20% of taxes on that qualified dividend. So that doesn't sound too bad, right? And as you can see, those are the different income levels for when you would pay what percentage. But if you are over a certain threshold, you might owe an additional net investment income tax as well. So keep that in mind. Now, if I switch the screens real quick and put up the ordinary tax rates, and this is both for 2020, you can see that you can pay anywhere from 10% all the way up to 37%. So obviously, the long-term capital gains tax rate was more advantageous because the maximum amount that you could pay was 20%, whereas the maximum amount that you can pay on the ordinary tax rate is 37%. Quite a big difference. And there is actually a significant amount of income that you can have to actually only pay 0% on long-term capital gains or qualified dividends, whereas the actual 0% tax rate is what's known as the standard deduction, which is currently only $24,800, whereas the 0% tax rate for long-term capital gains or qualified dividends goes all the way up to about $80,000. Knowing the rules and using them to your advantage is a big part of what this channel is all about. A big part of On Cash Flow is becoming a master of your own cash flow. And if you are enjoying this video so far, please don't forget to like it, give me a thumbs up, it really helps me out and I really do appreciate it. While at the same time, if you are enjoying it, please make sure you subscribe to the channel and put that bell for notifications, because every single week I am putting out new information on personal finance, currently Tuesdays and Fridays at 8 a.m. Pacific Standard Time, and I just know that there is something that I can help you with. But getting back to the dividends, when it comes to your own dividends, how much you are getting paid, it's really important to know how you can see how much of your dividends are ordinary and how much of them are qualified. In order to find this out, you're actually going to be looking at Form 1099 Tac DIV. And line 1A is going to be your ordinary dividends, and 1B is going to be your qualified dividends. So let me put Form 1099 Tac DIV on the screen really quick for you, just so you can see it. And so this is straight from the IRS website, and this is roughly what you're going to get. And this is probably going to come from your investment broker or wherever you are getting paid dividends from. And you can see 1A is total ordinary dividends and 1B is qualified dividends. When you file your taxes, that is where you will find the difference between your personal qualified dividends and your personal ordinary dividends. In order to get a qualified dividend, the dividend actually has to meet a few requirements. Now, I don't want to mess this up, so I'm going to read it straight from the IRS website. I'll put that on the screen so you can see and read along with me. But basically, it says the dividends must have been paid by a U.S. corporation or qualified foreign corporation. The dividends are not the type listed later, which I'll show you as well. And it must meet a certain holding period. But usually, if you're a long-term buy and hold investor, you are going to meet that holding period. Those are the basic requirements for your dividends to be qualified. Now, there are some dividends that you could receive that will never allow to be qualified, which was mentioned when I just read off those requirements. One type of dividend that is never going to be qualified is one that comes from a tax-exempt organization. Another might be a bank dividend or a shareholder dividend from a bank or a credit union. So those are actually treated as interest income and they are not treated as actual dividends. Whether they say they're dividends or not, they are treated as interest income. Another example would be a dividend that comes from an employee stock ownership plan, or what's known as an ESOP. A dividend from that will never be a qualified dividend. And there are a few other examples, but I think those are the main ones. The point is that not all sources of dividends will be qualified. But usually if they meet those first three really important requirements, then they can be classified as qualified dividends. And that is what you would want. When it comes to tax purposes, you would want qualified dividends rather than ordinary dividends because of their extremely favorable tax treatment. And if you want to learn a lot more about the difference between qualified and ordinary dividends, it's actually all in IRS Pub 550. So that's where I got all of my information from, and there's definitely a lot more that goes into it. But realistically, what we have discussed today is what most people would generally need to know about the difference between qualified and ordinary dividends. And if you want to continue about learning the rules and using them to your advantage, then I invite you to watch this video that I created if you haven't already. It is called How to Achieve Financial Independence in 10 Years or Less. And in that video, I give you a complete outline to becoming a master of your cash flow and to grow your net worth exponentially. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.